Hey everyone, welcome back to the Longacres Finance channel, where the mission is to find the best dividend stocks for safe, reliable, and growing passive income. If that's your goal too, join the community and subscribe to the channel. As we enter the last week of July, it's time to see which dividend aristocrats look to be potentially undervalued for the upcoming month. With one more week to go, the aristocrats are sitting about 1.3% up in terms of price return for the month. There are 17 potentially undervalued dividend aristocrats right now, and 7 aristocrats sitting in that 5% fairly valued zone. Valuation is determined by dividend yield theory, which works on the principle that quality dividend stocks revert to their historical trailing dividend yields over longer periods of time. So if a stock's current dividend yield is higher than its trailing dividend yield, the stock is potentially undervalued, and vice versa. How long it takes the stock to revert back to its historical dividend yield varies wildly. It could be a few days, a few months, or take even years. Sometimes the stock may never revert back to its historical dividend yield. This is why, in addition to finding potentially undervalued stocks, investors need to determine why the stock is potentially undervalued. Let's not get too far ahead, and take a look at the 17 potentially undervalued dividend aristocrats first. Here are the 17 undervalued aristocrats right now: Aflac, Atmos Energy, Ben Franklin, Clorox, Chevron, Consolidated Edison, Federal Realty Trust, General Dynamics, Hormel, IBM, Kimberly-Clark, 3M Company, People's United Financial, Cisco, AT&T, Walgreens, and Exxon. Collectively, these 17 companies are about 9% undervalued, with 3M being the closest to fair valuation, and Walgreens the furthest at about 27% undervalued right now. But does it make a difference if one stock is more undervalued than another? Well, it can. One way to think of undervaluation is as a margin of safety. If a stock is more undervalued, it gives you a higher margin of safety in case the market decides to dip. Finding undervalued stocks is nice, but the trick is to identify the undervalued stocks that are poised for the best growth in the future. Just because Walgreens is 27% undervalued now, doesn't imply it has a 27% edge on 3M, that is about 0.5% undervalued. What I like to do personally is to look at analyst forecasts for future earnings growth. There is a correlation between earnings growth and share price growth over a long period of time. Companies that are able to grow their earnings faster typically also see their share price appreciate more. Keep in mind these are analyst forecasts, and therefore only assumptions about where the company is headed. There are many other headwinds stocks face on a daily basis. And if we combine valuation with forecasts, we are combining two assumptions, which means that this type of analysis is even less reliable. But we must rely on data we have to make the best decisions we can. So let's take a look at the earnings growth assumptions for these 17 aristocrats. And then I will combine them with the valuation assumption to see which aristocrats are poised for the best growth. Here are the analyst forecasts taken from FinViz. And it looks like analysts are forecasting Cisco to have the highest earnings growth over the next 5 years. A 28.37% earnings growth forecast is quite bold for this food distributor. IBM also has a good-looking forecast of 16.36% annual earnings growth. People's United Financial looks strong with a 13.73% forecast. And Exxon is the only other company with a double-digit forecast. Instead of just using these forecasts, let's combine them with valuation. Since these are 5-year earnings assumptions, let's also assume that each of these stocks will return to fair value over the next 5 years. Let's invert and annualize the current undervaluation into a 5-year growth percentage, and then combine that growth with the earnings growth. And voila, here we have the expected earnings growth and the return to fair valuation for each company. Cisco still looks the most attractive with a 29.55% expected growth rate. And while I personally think that is a pretty bold growth rate for this company, who am I to judge? I know people often frown on analyst forecasts because they do make inaccurate predictions. But ask yourself, who should you get financial predictions from? Should I ask my next door neighbor, the IT guy, where he thinks a certain stock will go in the next 5 years? Or should I rely on Wall Street analysts, whose job it is to listen in on earnings calls, review financial statements, and stay current on market trends? I'll go with the analysts, and go to my neighbor if I have a computer problem. So now that we have these expected growth assumptions, should we just target the company with the highest growth rate and call it a day? No, that's not exactly a good practice when it comes to investing. What I do is take the top 3 or 5 or however many you feel like and add them to my short list of stocks. Then I'll dig a little deeper. And this depends on how involved you'd like to be. You can read insights into a company from Morningstar, CFRA, or Seeking Alpha. All 3 are my go-to places. I want to feel comfortable owning a piece of this company before I invest my money in them. That way, if the market decides to take a dip, I'm not second-guessing my decision or scrambling to sell for a loss. When I do deeper research, I look to understand how a business works. Is it operating profitably? And is it likely to grow in the future? There's no one metric that can answer all of these questions. If there was, we would all be rich. This is more of a skill set that comes with experience. The more you review companies, the easier it becomes. And even if you become great at this process, you will likely still make a few bad decisions. But you will also make a few correct ones, and those are the ones that will drive your portfolio returns. I know not everybody is willing to commit to such a process of investing, and that is absolutely fine. This is why index funds and ETFs were created, and they are wonderful products that can make you rich as well, with significantly less decisions and less risk. The Dividend Aristocrat ETF, ticker symbol NOBL, is up 14.5% this year, through month-end June. That is a very good rate of return, and while there are many individual Dividend Aristocrats that are doing much better, there are also many that are doing much worse. Let's get back to the Undervalued Dividend Aristocrats. So we have looked at the 17 Undervalued Aristocrats, their expected earnings growth, and the expected growth combined with current valuation. But what if there are overvalued Dividend Aristocrats that are poised for even higher growth, despite their current valuation? Let's find out. First, we will take a look at the 7 Dividend Aristocrats that are in the fair value zone, that is no more than 5% overvalued. And after that, we will take a look at all 65 Dividend Aristocrats. The companies that are currently in the fair value zone based on dividend yield theory are AbbVie, Amcor, A.O. Smith, Becton Dickinson, Cardinal Health, Leggett & Platt, and McCormick & Company. AbbVie and Amcor offer the best dividend yields, both above 4%. Cardinal and Leggett offer pretty decent 3% dividend yields, and the rest offer quite low dividend yields. Let's take a look at the forecast growth for these 7 aristocrats. It looks like Becton Dickinson has the best forecasted growth of 11.65%. The rest are all between 4 and 9%. Of course, when we combine these growth rates with valuation, the expected growth rate declines. Since these companies are potentially overvalued, a return to fair value would imply a decline in share price. The only attractive expected growth rate is for Becton Dickinson, with the rest being modest at best. Let's turn the filter off and take a look at all 65 aristocrats, to see if any of the other overvalued stocks have attractive forecasted growth rates. I can see a strong forecast for Albemarle of 29.83%, Caterpillar with a forecast of 31.41%, Chubb with a 23.62% growth forecast, McDonald's with a 20.51% forecast, Nucor with a 26.91% forecast, VF Corporation with a 22.4% forecast, and West Pharmaceuticals with a 25.8% forecast. Let's take a look at the combined earnings forecast and valuation. I'll filter the file for the top 10 expected growth rates, and we will see if they all happen to be undervalued stocks. And they are not. Only 3 of the 17 undervalued stocks made it into the top 10 forecasted expected earnings growth table: IBM, People's United, and Cisco. And as you can see, Albemarle and Nucor, despite being grossly overvalued based on dividend yield theory, are still forecast to grow quicker than some of the undervalued picks. Now, whether these forecasts will pan out, time will only tell. I propose a challenge between dividend yield theory and Wall Street analysts. Which will offer the better total return going forward? The top 10 most undervalued stocks, or the top 10 highest expected growth stocks? I think the undervalued stocks will start off slower, but may catch up to the highest expected growth stocks over the long term. I'll start tracking the returns of both going forward, and we will find out which method proves to be better. If you're still with me, thank you for watching this long. I'm not advocating any of these methods or stocks to anyone. The purpose of this video is to give you a short list of stocks for further review. I personally only happen to own Lowe's from this list, and I prefer to use my high yield and high growth watchlist method for stock selection. If you would like to know more about these methods, you can check out both watchlists on my channel, or a specific video about my Roth IRA, where I share my full asset allocation and portfolio structure. Feedback is always appreciated, so leave a comment below with any thoughts or questions. Thank you for watching, don't forget to subscribe, and see you next time.